Hi everyone, welcome to the trading plan workshop under the module, the method. We have 3 M's to the trading plan, the method, the mindset, and money. And today we're going to talk about the method or the strategy you use to trade. So I want to thank all of you for coming today. I know it was a special session and I appreciate it. I also just think it was necessary because we really had so much to get through, and although we went long the last time, we really needed all of these as well. So I'm glad to have all of you here. Um, I'm going to have Earl Ehrenler join us probably in about 15 minutes. He's just heading back. He was in kind of a loud area, so we wanted to have him be in a position where he could actually talk and answer questions. So I'm glad you guys are all here. Before we get going, I just kind of want to see how are all of you doing so far, either revising your own existing plan or starting to create a new one. How is that going for you? If you guys want to share a little bit of your progress this week so far. Right, Bill, I agree. Training the more is better. Um, So Jennifer, keep overhaul. What do you mean? And Ed says he writes every day, but mostly in the method area. That's okay. Juan is halfway revising his existing plan. Great. Okay. So it sounds like everyone is sort of in bits and pieces and revising it and working on it, which is good. Oh, okay. Now I understand what you mean, Jennifer. It was a complete overhaul. You didn't like the first plan you used. Okay. And that's fine. Joy says she's been trying to get up to speed to then write. That kind of makes sense because you also have to practice a little bit to kind of know what's working for you and what isn't. And sometimes you need to kind of get in the middle of stuff and then you can sort of back up and write more detail about various aspects of the plan or various elements of the plan for you. So yeah, that makes a lot of sense. Marty is working on strategies. Good. And Tony or David, what about you two? Stanley. Okay. All right. So let's go. All right. So the first aspect, what is in a trading plan? Um, well, Bill just said his plan is still on a pile of loose ends, and that's okay. You can actually piece them together, and just remember that this is a living document, so you always want to reserve the right to revise it and re-revise it and edit it, fine-tune it, if you will. So you'll pull it all together, Bill. Don't worry. And I'm sure other people are probably in the same boat as you. Um, Tony hasn't started working on it, but it's on his to-do list this weekend. That's great. Good. All right. So it sounds like everyone is at least hopefully being very forgiving of yourselves. That's the key. It's honestly, it's a plan that needs to suit you, and your you today is going to be a very different you next year. And so if you keep the same plan stale, it won't always work for you. So you have to make it suitable, customizable, and present. So the first thing you want to do is figure out what markets you want to trade. Okay? If you're still learning, what markets do you want to trade? So when I first started to learn VSA and I started to learn about the markets, I started with Forex, the spot Forex market, and I started to read baby pips. That was part of my research. I was working with Richard Seegers, who many of you probably know. He runs our Forex room. And he sort of turned me on to the Forex market. And then when he didn't have enough time to teach me, I didn't have enough learning at that point to really continue on my own yet. So Steve Phillips and Gavin were trading futures, so I moved over to futures and I started to learn that. So that's kind of where my learning has gone. And then in the next year, my goal is to start researching stocks. Kind of one of my goals is trying to merge VSA with fundamental analysis. Um, and I'm kind of really enjoying what I'm going to be doing with the education and the research on that. So if you're still learning, what markets do you want to trade? In other words, how are you going to get there? So you can also say, I want to trade the futures market and establish a short-term or medium-term goal for trading another market. Are there any of you that are thinking about looking into a new market that you haven't traded yet? Okay, good. So a number of you are saying yes. Jennifer, what's a market that you're interested in trading that you haven't traded yet? Forex. Okay, great. Then I definitely highly recommend babypips.com, P-I-P-S, babypips.com. They actually have a very cute thing where you go from being an infant and you graduate with like a doctorate or something in the Forex market. It's just a great overview. And remind me at the end of the webinar, I'll send you a packet on how volume works in the Forex market. And I can send you that. And anyone else that's interested, I'd be happy to send it to you. Marty said that he is interested in getting into futures. Now, Marty, I think based on conversations you and I have had, you started with stocks, right? Okay. And Joyce is interested possibly in getting involved in the futures market. She's never traded. Juan, futures and maybe ETFs in the future. The nice thing about ETFs, Juan, is you can actually look at, for example, the mini S&P and put it right beside the ETFs in the stock market, and they tend to trade very similarly. So it's, well, I wouldn't say it's easy. It's a natural migration from a stock ETF into a futures index. So something to consider, and depending on the questions you probably would want to ask is, you know, what the difference is maybe in the amount of size you need for an account, or how the transaction fees occur or the brokerage fees. So those are some things that might make your decision as well. Bill said, I'm using options as stock replacement due to the size of my account. Yes, actually, that is something I am going to be doing as well because of the size of the account. Joyce has only traded options in the stock market. Okay. So everyone is sort of, Ed said stocks with the scanners. Great. So yeah, so it looks like there's a little bit of everything. And then, you know, one of the things actually that Earl was talking about last week was that there's 7 markets within the futures market. So maybe you're at the moment looking at indices and then you want to look at grains or metals or futures currencies. I do the indices and I do the futures currencies. I don't have the brain capacity at the moment with everything else I'm doing to get into any other aspects. I know coffee looks good right now, and gold is obviously very hot. I just can't devote any more time at the moment to more markets within the futures market. So those are my 2 that I'm doing right now. Okay, so what you want to do within this, within element number 1, write down the markets that you're currently trading, all right? And then on a separate sheet of paper, or, you know, set it up if you're doing it online, on a second page, the market that you want to trade, and have a timeline for yourself on how you're going to learn it and when you're going to learn it. So let's go back to Jennifer's example because that one's a little bit easier than some of the other ones. She wants to learn Forex. So she's going to put on hers, she's going to say, I have not traded the Forex market yet, but I want to trade it by 2013. I will do the following things in the next 9 months to achieve that goal. And establish yourself, Jen, like a short-term goal, a medium-term goal, and a long-term goal. So you want to do the research on the market itself. You want to do the research on which pair you want to work. So maybe you want to do the euro dollar or you want to do the pound dollar, which they call the cable. Maybe there's something else you want to do instead, depending. I actually had started originally doing the cable, and then because of my commitments at work, I now do um, the Aussie dollar against the U.S. dollar, and I do the Japanese yen against the U.S. dollar because they trend at night when I'm home and I can trade. So for me, I had to choose those just by virtue of the times of the day that I was able to trade. So, set something up like that. Exactly. It is all in the timing, both in the timing that you have during the day and in the times that you have. Ed says, for options, check out optionshouse.com for a great platform, great tools, fabulous free webinars, and excellent commissions. Thank you, Ed. That's great. I would also say for futures, go to the cmegroup.com. They have an excellent host of educators that they use. And then the nice thing I will say that I do know from the futures market is the brokers that are around Chicago, because that's where the CME group is based, they all have professional traders and educators that speak often. So you can hop on some of their websites, like Infinity Futures or what's the other one? PFG Best. Some of those, ICE, ICE, like ice cubes, they all have very, very good webinars and links and information. And then I can also tell you, I read Futures for Dummies and I read Futures 101, Marcus Heitcutter's book for day trading. That's a very good book, and it's free if you just go to rockwelltrading.com. So those are a couple of good places for education. Set ground rules before trading a new market. So again, I'm just going to use Jennifer and her Forex example. So you're going to, read baby pips. You're going to talk to other Forex traders. You're going to have other things you want to figure out what you're going to do. And then what are the rules that you're going to do before you even actually place money into a new market, okay? So make sure all of that is part of number one. Now, if it's a market you're learning, or excuse me, a market that you are trading right now, you want to put in there, like I would put in here, the market I want to trade is the futures market, and then the instruments I'm going to trade are the ES, the NQ, the 6A, and the 6J. And I would be very specific about all four of those. I would list all four. Number two, what time frames you want to trade. Now, for those of you that may know, if you've been around VSA for a while, we always use the rule of three, 3 time frames to help confirm. There's no right or wrong answer. If you're doing an end-of-day situation, a stock trade, then you might only pick daily and weekly. So if you're doing intraday, it might be something different. So, and each strategy is going to dictate that as well. But you could start off with 2 to 3 time frames. Allow yourself to revise it again. Remember, it's a living document. So in the beginning, you might have 3 time frames that you like, and then you might find that, for example, the 1 minute is too noisy, or sometimes the 1 minute is counter-trending the rest of the market. So that's something that you may not want to use anymore. You might move up to the 3 minute. And I'm putting this in quotes because this would be something that I would put verbatim in my trading plan. I will look at the hourly, 30, and 15, and that's actually supposed to be an and 15, and that's supposed to be an and right there, and enter on the 5 minute. And that's actually something that I do at the moment. I go to the hourly just to see what it's doing. I watch the 30, particularly in the first hour of the market, and then I straddle between the 30 and the 15. And when I see a potential trade setup, I go in on the 5 minute and I enter and monitor my trade from there. When entering on the daily chart, I will always consider the weekly and the trend. So tell yourself what time frames you want to trade, and essentially not just why you want to trade those, but you want to say, I will look at these time frames to ensure that I'm trading with the trend, to make sure that, and here's another thing to consider too, the larger the time frame, the stronger the indicator, at least with VSA, or the stronger the trend, the less volatile. Now, I'm not saying that you have to use larger time frames to trade, but always keep those in mind even when you're focusing on a smaller time frame. And also, if you're looking at larger time frames, use smaller time frames to help you as well. So feel free to kind of scale up and down. That's the one thing I really like about our standalone platform is the multi-time frame scanner, so I can just really look quickly and see what's going on very, very quickly. What are some time frames that you guys have come to use? Anyone want to share a few time frames that have really worked well for you in conjunction with each other? Okay, Jennifer uses the 5, the 15, and the daily. Okay. Tony likes the daily. Great. All right. Number 3. Okay, Bill says, up to now I've been end of day, but I just downloaded the RTV4, so it will be changing. All right, well, then again, this is going to go back to revising your time frames, and each strategy will dictate a different time frame as well. One says the daily, the 30-minute, and the 5-minute. That's great. Okay. Number 3, a brief description of the trading strategies you will want to use and when you will use them. So obviously it'll depend on the market and it'll depend on the time frame. So I will use this strategy for a trending day. I will use this strategy for a range day. I will use this strategy for a scalp trade. I will use this strategy for a swing trade. Or I will use this strategy for the Forex market. I will use this strategy for the futures market. I will use this strategy for the stock market. It really depends on how the goal of the strategy, the objective of the strategy, not just obviously to make a profit. But the objective of the strategy should match both the time frames that you like and how you like to trade, when you like to trade. So I know when I asked you guys to do in the pre-work packet the 5 W's, the whole idea is to make you actually think, why do I even have this strategy? When am I using it? What's the reasoning behind it? What time frames? How does it work? How is my strategy set up? Did you guys find that helpful to make you like sort of break out your strategy to kind of, because sometimes either it might be a strategy you've been using for a long time, and until you're forced to actually answer the why, you don't always know the answer. And I think once you sit there and actually pick it apart, it allows you to then put it back together again, or allows you to kind of take a step away and come back to it. Does anyone want to share an example maybe of a strategy that you have right now that you are looking to revise? Maybe one of the 5 W's you weren't quite able to answer, or because you struggled with that answer, you knew that's the area you need to revise. Like, Bill, can I pick on you for a second? So you just said you downloaded the RT version. So you're going to be changing time frames. So maybe one of your strategies you're going to keep, but you're going to change the time frames and see basically how the strategy will now work in an intraday setting. Would that be probably accurate? So the strategy needs to be as specific for you to be able to answer all the 5 W's. The what, the when, the why, the how. Okay, Bill says he plans to use RT in swing trading and it'll give me better enter times. That's great. So then your strategy that you use when you revise it will be for a swing trade, and you will use these particular time frames to do it. So 2 and 3 will sort of match up. Good. Okay, number 4, the entry rules for the strategy. The more specific you are, the better for yourself. This also goes back to the mindset. So if you are impatient, then the more criteria you put for your entries, the better off you'll be. You'll be turning that potential obstacle into a solution. So I will enter when I see a no demand. I will enter when I see a no supply. I will enter when I see the following things happen. I will enter under these criteria. I will enter if these conditions have been met. One of the things in the dialog boxes is you have the description of the bar, and then you have the background, and then you have the future. So a good way to look at it is to say, I will go long when I see X. I will go long if I have um, strength in the background, several tests, 2 higher lows, lower volume. I will enter when I see ultra high volume or ultra low volume, things like that. The more specific you can be, the better. And this will ping pong with your trading journal. So after you've taken a trade, at the end of the day, you look at the trades you've taken and you analyze them. Your entry as you forward test these strategies will allow you to refine your entry points, refine your criteria for taking the trade, because then you'll see your success percentage on the other end. So if you, for example, will enter the trade and you will place your stop 2 ticks below or 2 ticks above, that might have to get refined. If you see, for example, on the no supply, if you see the market has now gone into an uptrend, you have a shakeout behind you, you have broken through the creek, and you now have gone, you've seen the pullback on much lower volume, and the next bar closes up. That's very, very specific, and that's a great way to define how and when and why you're taking the trade. Then when you go to your trading journal and you see the trade you took, you could go back to these 5 W's and check them off. Did I enter under these criteria, under this condition, because of this reason, when, during this time frame, et cetera, et cetera. So the two of them will kind of ping pong back and forth. Does that make sense? Okay. Does that seem helpful for you, that the more detailed you are, it'll kind of go back and forth? You can keep revising your entries. Maybe the strategy's fine, but maybe you're entering a little too early because you're impatient, and maybe that's a note that you make. So that's why you have to give yourself even more criteria. Or maybe you're super, super, super patient, which isn't necessarily a bad thing, and you realize afterwards that you keep missing part of the um, uptrend or part of the downtrend. So maybe you keep refining your entry criteria to help you find that sweet spot. Yeah, you could have a lot of strategies. Um, you don't want to get too bogged down with so many strategies until you forward tested them. I like what Steve says. He forward tests something 20 times and looks at his results before he'll go ahead and actually trade it live with real money. And that's exceptionally disciplined, and that's probably the reason why he's been a long-time successful professional trader. After the event last Saturday, I had a conversation with him on Monday, and I just said, that's amazing that you forward test 20 times. And he said, Lauren, I, almost blew out my entire account once. He's like, I had to. He's like, you start to force yourself to do it. And so my feeling is I don't necessarily want to make all the mistakes myself. Why not learn from other people's mistakes and take his advice in this example before losing all your money? Now, Bill says if we see trading as a war action, that's true. We could think of the journal as an after-action report. What happened and why, much like a SWOT. Right, so you can look at SWOT as your template to start. Okay, here's some things I know I do well. Here's some things I need to work on. Here's opportunities. Like, for example, Jennifer, I would put under your O the Forex market. That's an opportunity. It's not a weakness because you don't know it yet. That's an opportunity to trade. It's an opportunity to learn. And then threats, potential pitfalls. I was saying to you guys last week, Gavin doesn't have any threats because he wants to stay positive. Earl was trying to come up with things that could be out of your control, such as, MF Global going out of business. I kind of looked at it between the two and looked at it as taking that threat and turning it into a potential solution. I would also take some of those weaknesses and look at your weaknesses and see if you can be as specific as possible in your entry and exit criteria as well as your trading strategy, and see if you can eliminate some of those weaknesses or minimize them. Exactly. A threat is a challenge. Absolutely. Ed says it's hard to forward test a pure VSA strategy. An alternative could be use very small positions monitored carefully. Yep, I would agree with you, Ed. Yeah, Tom suggests that. I agree. You could set very, very, very small stops. One of the strategies that I use when I enter going long after I see a test or a no supply, I ended up actually refining it 3 to 4 more times. So I have Philip and I talk about this all the time. Philip's a little bit more conservative compared to Gavin and Tom, and I'm somewhere between, I would say, Gavin and Philip. And I was saying to him, I'm having a hard time figuring out when to go long. Like, I'm afraid that I'm going to go too early, and I need to figure it out. So I kept trying to figure out my entry point, and I kept refining it, and then that's how I forward tested it, Ed. So I sort of picked an early, a medium, and a late position, and I kept playing around with that until I felt pretty comfortable with my own risk tolerance and entry, where would work the best. And part of that was trying to revise the strategy. So I agree with you. I also think, though, you can be very specific, and it'll help you. I like to use if-then statements. If I see this, then I'll do that. If this appears, then I'll do that. And the reason why, too, is when you say it that way, you're only trading if it appears. You're not trading because you want to trade. That'll keep you out of over trading, potentially. And you're only going to trade if the following criteria occur. Again, that could be a weakness of yours. Maybe you really like to trade every single day. So if you keep very specific criteria, it could keep you out of a bad trade, and it could keep you out of overtrading. Number 5, when to exit the trade on the strategy. Now, I say this because every strategy is going to be different for you. If it's a very small scalp or swing, actually a swing is probably a better example. You're going to use most likely support and resistance, so you might exit on that specific resistance area, or you'll exit on ultra high volume. I will exit when this occurs. I will exit if I see this or that. Obviously, you'll exit if you hit your stop. Fine. But I heard someone say the problem with the exit is that you never exit correctly. You either exited too early or you exited too late, right? If you exit too early, you leave money on the table. You exit too late, you lose some money. But you have to still have criteria, guidelines, ability to recognize when to get out. Would you agree? I know that one of the hardest things is letting a good, profitable trade run, and that's something that you want to play around with. But the strategy should dictate to you your parameters for when you're going to get out of the trade. So Jennifer, I agree with you. Jennifer shared, I get stressed and do have a hard time letting it run. How many of you feel the same way? Yeah, so a lot of you feel that way. Ed says strategy could also include re-entry rules. Now, that's a very good example. Marcus Highcutter, who owns Rockwell Trading, he and I have spoken many, many times. And he has some of his strategies. He has a specific profit target. So when he hits that, he's out. Those are usually on his scalp trades. And then he has, one of the rules he has is he will not, let's say he's going long in the position and he closes it. He won't go long in that same, he won't re-enter that way. Other people might. He doesn't. That's a ground rule or a rule he has for himself. And I think it's kind of interesting. So, I think that that's something, again, that's personal and tailored. My feeling is, like, I'll give you a perfect example. If you see a shakeout and it reverses itself and it's a double bottom, you want to go long, but maybe you have a specific resistance area that you're going to um, eyeball, I would say, not necessarily put a hard stop on there or a hard exit. So you hit that, and then if the next bar closes down, maybe you exit the trade. Or if the next bar closes up, maybe you take half your contracts off, lock in the profit, and let the rest run. You can kind of do stuff like that. So it's kind of a partial exit. Um, so it's something that you need to refine as well. Now, obviously, if you're only trading with one contract, you don't have that ability, but you can still do, you can kind of play with that too. So I think it really depends on the position. Um, if you're going to run, let's say, if you're going to short the market after you've seen a market mushroom over, then like one of the exit criteria I have is if I go short after a no demand or a failed test, then I exit when I see a bottom reversal and the next bar closes up. That's one of my exits. I always do that. So because what I'm basically saying is I understand that I'm enjoying the down move. I'm monitoring the signs of strength and the start of accumulation. And as soon as I see a bottom-up move, I know that potentially the market's going to keep going up. And so I'd rather exit at that point and not stress myself out. Okay. Guideline number 6, what is in a trading plan? So guidelines and ground rules are a little bit open. This is where you're going to say to yourself when not to take a trade. For example, if you only trade with the trend, then you may not take a trade during a sideways moving market. You also have to stick to the criteria for entry and exit, which would then preclude you from taking a trade if you didn't meet those criteria. So a good sentence to put in here will be, I will not take a trade unless my entry criteria has been met for any given strategy. You should really put something like that in here because it's reaffirming what you've already put for your entry strategy and for your entry and exit. So again, I'll say it like this. I will only take a trade, keep it positive, I will only take a trade when the entry criteria have been met for each specific strategy. I will only trade under those conditions, something like that. What days you will and will not trade. Now, you're not going to trade on Sunday during the Forex market, but you may not trade on news days. That's a good one to say. I will not trade on a news day, or I will close my position out 5 minutes before a news event. I'm sure most of you are familiar with forexfactory.com. Let me type that in for you. The thing I love about that is they have a red light, green light, yellow light pictorial. So when you look under their news list, you actually see the events for the week, and you can go by the day or the week, and they list a ton of them, any news event that's coming out all over the world. And they actually put a red, a yellow, or a green color coding, which tells you how critical they are, the level of importance or potential strong effect it'll have on the market. So if, for example, one of the things you could put in here is I will not trade or I will exit out of a trade 5 minutes before any red folder news event. That's something that's in my trading plan. And I call it the red folder news event, and that's tied directly to the red colored folder in Forex Factory. Because some of these things I don't even realize have an effect, and I don't think about it. Now, for example, something that has to do with grains, if you're trading the futures grains, then of course that'll have an effect on it. Unemployment numbers, jobs reports, anytime Bernanke speaks, the issues that were going on with Greece, those type of things. So any of those news events will affect you. So that's something to put in here as well. Some people don't trade on Friday afternoons because New York tends to take half days and they don't really, the volume drops off. Some people won't trade the first 30 minutes and the last 30 minutes of the day. It could be things like that. Can you guys give me an example of stuff that you kind of developed or that you're working on in terms of when you will and will not trade? Right before a major news release, exactly. Do you have a criteria, Tony? Do you do 5 minutes before or you just don't do it at all? Jennifer says, I will not trade if I was up all night with a sick kid and can't get my mind wrapped around the market. So a good thing to say, try and say it this way. I will only trade when I feel good about myself and my mind, or I feel clear-headed, or I feel like I can sit in front of the computer and trade cleanly or effectively, something like that. Joy says she does not typically trade in the first 30 minutes, and you don't like to trade through the earnings report. Good. Yeah, sure, Bill. I'll put in that. Okay, so let's put in www.babytips.com. It's excellent. Yes, Jennifer, you're right. Keep it positive. So instead of saying I will not trade, say I will only trade. I will stay out of the market 3 minutes before a major news event. I will stay out of the market the first 30 minutes it opens. I will stay out of the market the last 30 minutes of the day, something like that. I will only trade when I feel emotionally, mentally, and physically capable to trade. That's a great one to say. Fiona isn't here today. She's traveling, and one of the things she had shared with me in the past is she will not trade when her significant other is in the room because she gets distracted and she's lost a lot of money whenever he's walked in the room. So I actually think that's pretty funny. So that's something that, you may not want to choose to share with your significant other, but if that's something that is definitely a distraction for you, then you should definitely put that in there. I don't know the answer to that, Joyce. I'm sure he is. But another thing, Jennifer, you mentioned kids. So it's probably not the best time of day for you to trade when they first get home from school and they have a lot of needs at that point. Or, you're not going to trade when things are going on in your household, dinner time or when the family's trying to get out the door or something like that. Maybe you want to make sure you're exited out of a trade 5 minutes before the bus arrives, something like that. But again, it's tailored to you and it's specific to you. And what it'll do is when you put it on paper, you've done two things. You've taken it out of your brain and you've made it real. And second, you've made a point to force yourself to look at it. And when you look at it and you've written it down and you've made it permanent, then you are more likely to stick to it. Another thing you can do is read it. Okay, Jennifer just said, yep, I've lost money when the kids get home and I've been pulled away from the computer without a stop loss in. So two things there. One, make sure you have a stop loss because that goes back to the risk management. And two, set an alarm clock for yourself that you need to 5 minutes before the kids get home. So if they get home at 2:35, then your alarm should go off at 2:30, and you need to exit your trades. Also, depending on what market you're trading and where you are in the world, you need to be aware of the time difference. So for me in Chicago, at 7:30, the Chicago pre-market opens. At 8:30 my time, New York opens. Well, I need to be very cognizant of that. So I set an alarm at 8:25. and I don't trade the first half an hour of the market. So, and just like I was saying to you, part of the reason why I chose the 6A and the 6J is because it worked for my time, the time of day when I can trade. That's something to also think of. Sometimes the market might pick you based on when you can trade and when you can't, or the instrument that you're looking at might trade better during certain times of day that work better for you. So it's certain things like that. Another thing I can tell you too, just through experience, and I'm sure if you talk to other traders, they'll say the same thing. If the market doesn't trend by 11 o'clock, then chances are most likely it's not going to trend for the rest of the day. So if you know that, you have to have a strategy for a non-trending day if you want to be able to trend. If you want to be able to trade. Another thing is if the market only trends 30% of the time, approximately speaking, then what are you doing the other 70% of the time? Now, you could say, well, then I just don't trade. Fine. But if you need to come up with something for 70% of the time, then you need to have a good non-trending day strategy or range strategy or swing strategy or scalp strategy, something like that. Another thing that goes in these guidelines or ground rules, times of day you will and will not trade, yes, and also you may not trade the week of Thanksgiving or the week between Christmas and New Year's because those are the low volume days. Something to be considered about that. Okay, again, write them down because then they become real. Okay, ground rules continued. Hang on one sec, guys. Sorry, I was just trying to see where Earl was. Okay, ground rules continued. So checklists, your pre- and post-market checklists. Last week we had Gavin and Steve Phillips go over how they start their day. Those are part of their daily checklists, what goes into how they approach the market, what goes into how they feel about themselves, what goes into the activities that they do before the market opens. The other thing is your post-market. So part of your post-market checklist should have things like analyzing the trades that you took, looking at your goals and seeing if you achieved them. Remember, your goals need to be measurable and trackable. So at the end of the day, you should be looking over your goals, at least your short-term ones, and then maybe by the end of the week, look over your medium and longer-term ones so you can see if you've achieved them. Again, goals that are measurable and definable. And then turning your obstacles into opportunities. So your SWOT is also part of your ground rules and your rules for trading or ground rules or parameters surrounding your trading. But turning your obstacles into opportunities is really, really important. I'm going to have you take a moment now to either look at the obstacles you already wrote down during your pre-market workshop, or just write down an obstacle you have now. And we'll put it to the group. I won't say, I want you to share it with me if you can write it in the chat box, but I won't say who you are. And we'll put it to the group anonymously and give the obstacle. And then all of us will try and come up with a solution or an opportunity for you. So I'll give you a minute to either look at one of your obstacles you've already put or be able to think of one now, and then just write it in the chat box for me. A couple of people have written some things. I'm just going to wait until some more people write them down, and then again, I'll anonymously share them with the group. All right, let's pick one at random, and we'll start with that one. Impulsively trading. So someone submitted impulsively trading. How can we help this person turn that obstacle into a solution or create an opportunity out of that? What's something we could add to our plan that would help minimize impulsively trading? Okay, meeting the criteria before taking the trade. I think that's a great thing to help minimize impulsivity. Someone else suggested working within those goals and limits, such as no more than something. Okay, so for example, maybe you won't trade more than X amount of money a day or X amount of trades a day or a week. I also think if you're very specific about your criteria for entry and you're very specific about your strategy, and part of your ground rules is to say, I will only trade when I see if-then statements. If I see this, then I'll trade, or I will only trade when the criteria has been met. I think that could be a good way to reduce your impulsivity. And then I would also suggest to that person, when you do your trading journal, tick off if this was an impulsive trade for you. If when you're revising it or analyzing it, if this was actually an impulsive trade for you. And that's something to note. Okay. One person said fear, fear of making a mistake, which is an obstacle this person has because of a past mistake that they have already made. Now that is a major common thing. So I would say one of the things you can do is be as specific as possible about your strategy and really, really study your strategy. Use the forward testing model 10 times, 15 times, 20 times. Paper trade it until you really feel confident. Can anyone else suggest to this person how to get past a fear of a past mistake? Because I'm sure all of you have had a losing trade one time or another that has really thrown you for a loop. Okay. One person suggests using a very small amount of money. So your risk management is very tiny. Therefore, if you lose money or you make a mistake again, it won't hurt so bad financially. That's a very good suggestion. Paper trading until your win-loss ratio or account size is back up. Absolutely. I would also say, and you may think I'm silly, but I totally disagree. No, I am silly. But one thing I would say is some daily affirmations for yourself with regard to trading. So you would say, I feel confident about the education that I've already done. I feel confident about sitting in front of this computer. Um, I feel confident about the strategy that I have proposed and tested, and I feel comfortable taking this trade. And I think the more affirmative you are for yourself, the more confidence you'll gain, regardless of the outcome. Another person suggests to objectify the trade into a matrix of rules and journal it before and after. Very good. That way, it's not a mistake no matter how it turns out. Good. So one of the aspects of a trading journal is why you took the trade and how it went and why. It went well because, it didn't go well because. And I even do that with a winning trade. I might have taken profit too soon, and I want to make a point of that, because that way, kind of going back to what some of us were saying, you get a little nervous letting a good trade run, and that can help you also. Okay, let's go to another person's obstacle. When to enter. Okay, so I would say entry, you need to make sure that your strategy allows you either for multiple entries or allows you to be very specific in your criteria for entry, and then you'll know if you entered correctly or not. Can anyone else suggest helping this person with trade entries? One person suggests looking at your trade and reviewing it out loud as if you're trying to explain it to someone else. That could sort of go back to both the person who was suffering from fear of making a mistake, someone who wasn't sure about their entry. Let's see. Okay. One person suggests looking at the ticks. If the trend of the market internals are going your way, then chances are the trade will go your way. Okay, so that'll help you feel better about your trade entry. Go over past setups to get a sense of probability value. Yes, one of the things that I did when I said I was forward testing where I placed my entry after seeing a no supply is I kind of did a riskier one, what I thought was risky, a more conservative one, and then what I thought was kind of a late one. And I kind of went back and forth and refined it and refined it. One person says, find a simple entry, learn it well, test it. You will be all right as long as your risk management is good. So again, as we keep saying to ourselves, having a journal to be able to analyze why we took the trade, having a really well-defined entry criteria and a really good strategy will help you. And obviously journaling it. And not being afraid to revise your strategy, revise your entry, and keep refining your trading journal. Good. All right, let's go to another obstacle for someone. Give me a second. I have to scroll up because we've been giving so much good past. All right, let's see. Someone is struggling. One obstacle for them is dealing with the tendency to force a trade that is not there. I would say one of the things you should put in your ground rules is something like I will only trade when, or I will only trade if, making sure that the entry criteria, again, is very specific and solid. Can anyone else suggest something for that person? Again, forcing a trade that's not there. Trade what you see, not what you want to see. I actually have that mantra in my trading plan. Trade what you see or trade what's there. Someone suggested if the trade is not there, then look at different instruments or a different stock or a different index, if you will. So if it's not happening in the S&P, then look at the NASDAQ or look at the Russell or look at the Dow. Good. Okay. Let me see. Let's go to another obstacle. One person is struggling with scheduling time each day to focus on trading because life gets in the way, of course, work interruptions, um, travel requirements for the job. So I think that you have to set up an appointment with yourself. Again, that's very silly, but I worked with a professional coach, a training coach, if you will, life coach, a long time ago, and I started setting up appointments for myself, and that's how I managed to go to the gym. So when people ask me if I'm free, the answer is no, I'm not free, because I've set that appointment for myself. So if you know that you can find time, and it doesn't always have to be the same time every day, it may not be between 8 and 8:30 every morning, but if you know that you can carve out a half an hour based on your schedule, maybe look at it every Sunday and look at your schedule the whole week and choose a half an hour and block it off every day for the whole week. That will help you give yourself the time. Maybe one day a week is when you catch up on all the, for example, the VSA Club webinars that you missed for the week. Maybe you don't get to see them live throughout the week, so you watch them on Saturday mornings. That's fine. Can anyone else give an example or provide an opportunity for this person um, who's struggling with, time and life and travel commitments with job? Yep, I definitely think some markets are more flexible than others. Forex is open all the time. Futures market is open 23 and a half hours a day. The closes from 3:15 to 5 o'clock. So sometimes maybe the stock market isn't the best one to get into. Um, One person suggests having the ability to say no or no thank you. Right, not always being so acquiescent that you end up um, overextended. Sometimes you don't have a choice, though, if the job is doing that. But I'll tell you, one of the reasons why, even though I really loved the American market, unless I want to get up in the middle of the night and trade London, I forced myself to end up learning the 6A and the 6J because they trend at night, and that's the only time I can trade. I can't trade during the day because I'm talking to wonderful folks like you. So, okay, I think this was really helpful. So again, when you do your SWOT analysis or you look at some of your obstacles, um, figure out the why behind it and try and turn it into an opportunity. Now, Brandon isn't with us today, but he had asked if we could all share our SWOT analysis. And I haven't seen any come through this week. So I was wondering if anyone had a chance to work on those, and if so, if you could email it to me, it would be great. Has anyone had a chance to work on theirs? Good. So Jennifer, when you're done, do you mind sending it to me? It's just a great start. Helps other people as well. Okay. So whenever you guys get a chance to do it, if you just want to forward it on to me, I'd be really appreciative, and I know other people would too. And I don't mind stripping the name and just submitting them as anonymous. So that's fine too. That's no problem at all. Okay, I'll give you a good example of strength. So for me, a huge strength I have is the ability to call Steve Phillips up on the phone or Gavin anytime I want and ask him about something. That's a huge strength for me. A strength for you could be you have done a lot of the research and the knowledge of that particular market and that particular instrument. Another strength is the viability of your trading strategy. Trading strategies are huge strengths. If your strategy is good and it's really successful and it's just a matter of sort of enacting it. Another thing about strengths could be aspects of your personality or skill set that you have that allow you to be a good trader. For example, Maybe you're somebody who is not easily distracted. I would also say, too, I think some of the reason why trading appeals to some people is that they actually are very interactive and have a hard time focusing on just one thing. So because the market's moving so fast, that might be really appealing to them. They could actually have their brain kind of calm down a little bit. So that might be calming for them. So that might be a way that maybe reading a book could never be good for them, but trading really provides them with a lot of stimuli, which then has the opposite effect. I used to teach special ed, and the kids, many of them had ADHD, and I always thought it was weird at first when I realized that the medication they took was actually a stimulant, but for them, it actually had the opposite effect. So sometimes trading and watching the market can do that too. Someone else gave an example as a strength for them, determined. And then someone else suggested one of their threats or challenges they face is picking a trading platform. That's a good one. So I definitely can tell you that there are loads and loads and loads of articles out there about how to pick the right broker or how to pick a trading platform. Also, feel free to try and pick up threads on, feedback, positive or negative, about any of them. People love to give reviews. So there's definitely a whole host of information out there on the internet that you can find. And also, I always go with my gut. So when you call them up and you talk to the broker, see how you feel after you talk to them. I know I can't remember who it is, and I would never want to badmouth a particular trading platform or a particular brokerage firm, but I know somebody said to me, oh, those people are really cheap transaction-wise, but try and get them on the phone, good luck. So depending on what you need, that might be a consideration as well. Okay. All right. Number 7, the money management, which is what we talked about last week. So part of the money management would be how much capital, how much working capital you have, and how to allocate the funds. And this is going to be revised over and over again because hopefully, willfully, you'll start gaining more money and have more options. And also, as your interest and education and expertise and skill set increase, you will start not only maybe putting larger amounts per trade, but you might be entering new markets, and you'll have to allocate your funds accordingly. We talked about the reward to risk ratio. You want to do that for each strategy in each market. And I really need to stress that because each strategy might force you to have a larger risk-reward ratio than other ones. We talked about stop management. Some of them you might do a trailing stop. Some of them you might have a bracket order or a hard stop. Profit targets, again, some of them you might have a specific profit target in mind, 3 points, 3 pips, or a hard line that you're looking for. But you also want to, when you're looking at your strategies, in your trading journal, you're going to put how much you made, and you want to do it in 2 ways. You want to do how much you made in pips or ticks or points, and how much you made in dollars or yen or pounds, because both have a psychological effect on you. Let's see. Yes, thank you. Right, Jen, you're absolutely right. So some of your accounts are restricted, right? So you can't short them. Absolutely, and this is where you're going to put that in. Because you can only go long, then your going long strategy is going to take into account some of your risk reward and what you're allowed within that account. Some of them have very strict rules for that. So yeah, very good thing to add. Thank you. So those are the 7 elements. So we kind of talked about the obstacles, which goes into your SWOT and goes into number 6, your ground rules for trading. Your goals will go into your pre and post checklist. And if you're always looking at your goals and always looking at how you can revise this plan, then the plan is going to be really, it's going to be really viable for you, usable, and portable. I mean, I say portable. Obviously, you're not carrying it around like in a briefcase, but I mean portable, like it goes with you wherever you go. it's readily available to you. Does anyone have any questions about any of these 7 elements? I can go over any aspect of it, no problem. Okay. If you do, just let me know and I'll go back. That's the nice thing about only having a few people. Okay, one person had a question about profit targets. Profit targets could be broken out in 2 ways. You could do it as a specific amount of money. I would also, profit targets should also be tied into your short-term goals. For example, if on the E-mini and you want to make, or in the futures market itself, you want to make 3 points per day or per trade on average. By the time you average it out, you're averaging 3 points per trade. That would be one of your profit targets as well. So your profit target is 3 points, and then you are willing to do 6 points, which is huge and astronomical. That would be a 1-to-2 ratio for your reward to risk. So maybe instead you want to earn 3 points, you're willing to risk 2. Profit targets are also when the price hits a certain point, then that's when I will get out. So one strategy I know that Steve Phillips had shared with me as well, he has one, he didn't go into great detail with me, but he basically said I only let it run for 2 bars. So that kind of goes into his profit target as well. Stop management is a contentious issue and very personal. Yeah, I mean, we talked about risk management last week because it has to do with your risk tolerance. It has to do with how you feel at the moment and what you're willing to do. So, and you need to figure out what works for you. And again, going back to that reward to risk ratio for each strategy and each method, you want to make sure that it aligns with how you feel, and then that also is something that you're constantly revising and analyzing. So put it as also, the more detailed your trading journal is, the better off you are for yourself. Because you could look back, let's say, at the end of this month, and, maybe your success went down. Look at what you did in March. That'll give you a much better idea of where you went wrong or what changed and why. Again, always analyzing your own actions and then your own reactions. So, okay, I'm going to skip this. I'm not sure where Earl is at the moment, guys. His section right now, he's going to go over his strategies, but I'm going to skip to me and Gavin, and we'll go back to him when he gets here. So let's start with this one. And, all right, so any of you that have ever watched if you have Gavin's book, or if you have listened to any of his videos, he always talks about BP because this is a perfect example of not just market manipulation, but if you look here, this is like one of the biggest, he calls it the Yao Ming, so I put GH for Gavin. This is an ultra, ultra, ultra high volume. It's also the highest you've seen for months and months and months. It is tied directly into bad news. And oftentimes that is the case, right? These ultra-high volumes are tied to quarterly earnings, for example, or news events that are surrounded with the company. So start with the Yao Ming. Start with that ultra-high volume. That's what he does when he starts scanning charts. That's what he does when he looks at a chart. He wants to know if he has a Yao Ming, because what we know is that these ultra-high volumes are the start of a campaign by the smart money. So this is when it allows you to understand that something's going on, something's happening. Now, you may not trade it right away, but you're going to pay attention to it, and then you want to see what happens after it. So this is tied directly into the news event that BP announces they can't cap the well. And then, the whole world boo-hoos and the market starts to fall. Okay, so let's look at some of these pictures, right? We have the herd. I wish I could bleat like a sheep, but I can't. But this is the herd. This is what you used to be until you started to understand the markets were manipulated. This is the wolf in sheep's clothing, right? That's the smart money. They're often disguising their actions, but we need to be detectives and uncover what's going on. So, bad news, the market falls. Doom and gloom, Libya is taking over BP. That was part of the problem after they said that they couldn't cap the well. Woe is me, the company is going to collapse. Libya is going to take it over. The volume and the shakeout help you understand it is just a maneuver. So this is the thing. You know enough now, you're smart enough now, clever enough now, wily, to realize that the ultra-high volume is a maneuver by the smart money. So you pay attention to that, and that'll tell you, what basically the why behind the maneuver or the why behind the action. So when other people sit there and scratch their heads and don't understand what happened, or they say, oh, it's because of that, you know better. You go, oh, great. Thanks for letting me know. I'm really glad I saw that ultra-high volume. Now I know to wait and prepare and trade accordingly. All right, so here's the larger time frame. What we were showing you was the daily. This is the monthly. So again, this is when they couldn't cap the well. And this was an earlier low. So it basically revisits that low here, and then it springs right back up again, and it touches down back into this testing ground, and then goes up the whole way. And that is, looking at multiple time frames, seeing confirmation, using support and resistance, understanding that the price was basically coming back down to a historic low, and it had enough volume to break through any other previous support areas, and then sprang right back off of that again. So understanding how that Yao Ming or that skyscraper, which is what I call it, how that plays into it for you, is going to give you a very good commanding understanding of the market in generalities. It'll also help you determine market bottoms and market tops. Now, breakout bars, we typically look at a breakout, or at least when I think of a breakout, I always think of a breakout to the upside. How many of you, when I say breakout, kind of mostly think to the upside? Yeah. Well, break out or break down, it's the same way. So if you think about a car going up the hill, it needs enough momentum or effort or volume, which is where volume comes into play, to tell you if there's enough volume to break through an old top to the left. So that's why when I put my trend clusters on and the market starts to rise towards a certain high, I always look to the left to see if I'm at an old top, and if I am, what's the volume comparatively? Does it have enough energy or effort, or is the volume high enough to keep going up? We saw that with Apple this week. It kind of approached and then fell right off again, and then reapproached 3 days later and fell off again. And so to the downside, you have very short fall. I mean, this had just kind of been doing this, right? And then ever since then, that was back in 2008. So, 2002. So it goes all the way up, all the way up, all the way up. It sort of goes a little flat. It comes back up through here. This was a high and it had completely reversed itself. We had a high and that completely went over. We come up and it comes right back down again. Note the volume really wasn't significant comparatively. And then you end up with this free falling market, okay? And then it corrects itself. Notice the higher volume here. And it comes back up again. And then it comes right back up. And then it comes crashing down. Look at that. Look at how many bars it took to get down to that, and look at how it only took a few bars to get all the way down. That's how violent this fall was, and that's how large this volume was. Even the volume right before it was still really, really high, and then the one after it. So you use support and resistance. You use double, or in this case, triple bottoms. The larger time frames will also give you a bigger background and more to consider. But if you think about volume as the ability to crash through a support area or push up and break through a resistance area, then you are already one step ahead of other people. So one of the things you always want to look for is as the market is rising and the volume is waning, that's an inverse relationship and it can't sustain. Likewise, as the market is falling and the volume's getting less, and then you get a shakeout like this, you always want to know, is it going to continue to fall after such a widespread down bar? If it suddenly reverses itself like this, then it probably doesn't have enough energy. Here's another example. Look at how this reverses itself. Now watch this. The price rises, okay, but the volume decreases. See that? Volume's decreasing, volume's decreasing. It doesn't have enough momentum to break through this first huge falling bar. And sure enough, you get weakness and it starts to fall again, and then it comes back down, not as bad as this, but it comes back down into this area. It comes down and immediately reverses itself again. And then it starts to come up. And again, I would ask myself, is there enough volume to sustain? So that's kind of how you approach a market top and a market bottom. You want to start with the Yao Ming. You want to use multiple time frames, and you want to ask yourself, is there enough volume to continue? Is everyone okay? Can I move forward? Okay, great. Obviously, just insert any questions you have as we go along, no problem. Okay, so support and resistance. Allow you to see where previous accumulation or distribution happened. Now, how many of you use support and resistance? I usually make this assumption that everybody does, but I really should stop assuming. Okay. Okay. So basically, it allows you, okay, Marty, that's realistic. You're learning to use it. And Ed says somewhat, but you intend to use it much more with the VSA tools. I will tell you, and it's not because I'm the biggest cheerleader of VSA. I think in fairness to all of you, this is the only thing I learned from the get-go. So it's always been something that's been drilled into me. But when I was first learning it, I was asking Philip Friston a gazillion questions, and he was oh so patient. Love that man. And both him and Gavin, as well as Steve and Tom Williams, they said, VSA is great, but you need support and resistance, because one of the things Richard Seegers had said to me day one, minute one, price has a tendency to return from whence it came. Price has a tendency to return from whence it came. And that's why some of those waves tend to target some of that. So that's why swing trades, pivots, those can help you, because if the price tends to return from whence it came, it's sort of numbers theory. Support and resistance sort of helps you understand when it's going to hit it, or as it approaches that top or bottom. Again, like I said, adding VSA to that, does it have enough momentum to continue to fall or continue to rise? So, and also, too, if you think about the ebbs and the flows. Now, stocks, speaking of stocks, it's a 10-year cycle typically that you'll see stuff like that. That tends to be a cycle that they use. My feeling is the market is sort of, willy-nilly at the moment, and I think that the cycles are the cycles based on what's going on and the volatility at the moment. So I think if you're not hard and fast about anything, if you just, understand, kind of where the price was and then what happened. A good way to, if you don't have our standalone system with the trend clusters and you're using, one of the other platforms, one of the other plugins, or you have a different plugin that you're using, a platform, that you're using at the moment, look at reversals. Start with your reversals. One of the things I did in the very beginning is I looked at my upthrusts and I looked at my shakeouts. And I started marking the close of the upthrust and the bottoms of the shakeouts. or excuse me, the close of the up thrusts and the close of the shakeouts. And I started looking at those, market tops, market bottoms. And then that helped me identify a double top or a double bottom, your M's or your W's. You guys are familiar with that pattern, right? Your M or your W. So you either have two mountain peaks or you have two, what looks like a W. So those will help you. The other thing that support and resistance helps you is it helps you identify a zone from within to trade. Now, sometimes the zones are so large that you need to have mini zones, which is where climactic action will help you as well. That'll tell you where something has started and then it's starting to fall, or where it started and something is starting to rise. Again, double bottoms and ultra high volume, great long trade setups. Double tops and low volume, great short trade setups. So again, you see a double bottom like a W, and you get these ultra high volumes from the shakeouts and then the reversals. Those are great long trade setups. I don't mean you go long right then and there, but that's where you look for. That's where you look for the start of it. Double tops with low volume. Again, think about a car trying to go up the hill. It runs out of gas. That's when you know it's going to mushroom over or roll back over. Those are great short trade setups to be looking for. Can we move forward with this? Everyone okay with this slide? The devil horns. Yeah, that works. Double tops, devil horns, sure. Okay, everyone seems okay with this one. All right, so VSA strategy from scratch. Look for high to ultra high volume, that Yao Ming or that skyscraper bar. Okay, that's going to help you identify climactic action and help you identify the start of a cause or a campaign. Look for a widespread bar on that volume. Okay, and you guys know what I mean by climactic action, right? The high volume and the widespread bar, either to the upside or the downside. Does everyone feel comfortable identifying it on a chart? Do you think you could pick it out on your own? Okay. All right, good. Now you want to ask yourself, is the market in a clear trend? Yes or no? And that's kind of why I also like the medium-term trending bars, the short-term trending tool. You could certainly use RSI or moving averages. That'll help you as well. So if the market is in a clear trend, note the close of the bar. I say note. You're not always going to mark it. I often mark the close of the bar to help me understand when the price returns back to that point. But you want to note the close of the bar in order to alert you to the start of the campaign. Is there a news event? For example, when you get a huge gap up or a huge fall down, is it because there was a bad news event or a major news or earnings report or something like that? So, you don't necessarily need to trade the news, but when you're looking at a chart and you see this ultra high volume widespread bar, you kind of want to know too. Okay. And if there is no trend, then wait, right? Now, most of VSA is to trade with the trend and to identify the trend and to be patient and to trade accordingly. I understand there are also specific strategies for range days. I get that. But 99% of the time when we're talking about this, it's for a trending situation. But if the market isn't yet in a clear trend, then I just use the word yet. If it's not clear yet, then just wait. Okay, so finding a good short. This was Citigroup. This is the daily chart. Again, notice what you see here. Okay, the market was starting to rise. This is a daily chart again. So the market is starting to rise, and as it approaches this area, it starts to come away. And then you get these two high volume bars that are trying really hard to push it back up again. But notice what happens. As soon as it reaches this area, the volume gets lower. It starts to get a little lower, the volume gets lower. It tries to push it up again, but the volume is really low. This is telling me that there is not enough energy or momentum or forward push to push this market up. It is weak. I have weakness in the background, and I now have a proven low volume at a market top, okay, which happens to come in the form of a no demand on A. But we also know that that could be an upthrust. It could be a reversal after effort to rise, selling pressure. But basically, what you're looking for is as the market rises and the volume goes away, does it get kicked sideways? And usually that's what happens. It often doesn't just come right off, unless you're talking about a 1-minute chart. But usually this is what happens. So you get these two big guns to try and push it back up again, and it fails miserably. And as it reaches this top, the volume gets lower, and you start to come down. And you come up again, back up into this area, and you come down. The volume is still pretty high right here. It really gives the appearance that they're trying really, really hard to push it back up. Now, the reason why B is such a good position is that you're now had the weakness in the background and a reversal to rise. I call it, a failure to thrive or a failure to rise, an inability to keep going up because of low volume. So I get my failure at the market top, and it starts to mushroom over. B also works because I've already left the uptrend behind. And thank you, Jennifer. You're absolutely right. I was just going to say to you, the interesting thing about this one, though, is that you're not in a red diamond. However, when we were talking about multi-time frames, one of the things that I will say to you is if it's in a daily or an hourly and it's in the right place, then I look at a smaller time frame to enter. So it can be white in a daily or an hourly if my half an hour, 15-minute, and 5-minute have all gone red, because they go red quicker, than the larger time frame. So the problem with the 4-hour time frame is that it's a weird time frame, and sometimes the 4-hour time frame doesn't always trend in line with the daily and the hourly. So it's on my watch list. I always have it on my multi-time frame scanner, but I often note that it's doing its own thing. So here's the criteria for a short position, okay? I'm exceptionally specific about when I take a short. All right, I have climactic action and distribution in place. And again, climactic action, we see a high volume, widespread bar, in this case with distribution because we're looking for a short. I basically get the rise, I get the start of the selling phase, and I note it, okay? I note the close, and I have distribution in place, okay? I have a failure to rise, all right? So in the first arrow, I get a market up, and look at the volume, it goes away, it comes down, it trends sideways, it comes back down, still into this area, comes back up again into this trend cluster. That's why I love trend clusters. And basically, as soon as the market tries to go up, the very next bar takes it out. This is a 2-bar reversal right here, okay? So I get one, and now a second failure to rise. I get low volume up bars, all right? Low volume up bars in a rising market is an excellent sign of weakness. That's when you can get ready to prepare for a short, okay? All of this is on my trading strategy for taking a short position. I need climactic action. I mark the close of the bar. I need to see that distribution is in place, that it's not just 2 up bars and then it goes away. I look for a failure to rise by looking at low volume up bars. Okay. Again, criteria for my short position. This is all in my short strategy. The market starts to fall, meaning I've recognized the distribution, I've recognized the mushrooming over, but I am never taking a short until the market has already starting to go in the down direction, okay? I'm not counter-trending. I'm in a downtrend, red diamonds. Now, the chart I showed you, again, was the white diamond, but that's because it was in a daily, and I make that same criteria. I will allow 2 red diamonds and not 3, or I will allow even a white diamond on an hourly, especially on the S&P and the NASDAQ. If I see a white arrow in, a white diamond in the 1 hour, as long as the 30-minute and the 15-minute are red, I'm confirmed. I get a no demand on much lower volume. Now, the no demand and a failed test, so there's two things about a failed test. The one thing about a no demand is it's an up bar. The narrower the better. The lower the volume, the better. The next bar needs to close down. That's a confirmed no demand, okay? If I get a no supply, which is also that pinky purple color, volume lower than the previous two, and it's narrow and the volume's lower, the lower the better, and it fails, meaning the next bar closes down instead of up, that is the same as a confirmed no demand. So a failed no supply is the same for me as a confirmed no demand. So that's also in my criteria. I get a no demand. Essentially what I mean by this is I get a confirmed no demand on much lower volume, or I get a failed no supply. Do you guys feel comfortable with that? Because they're essentially reciprocals of each other. They're the yin and the yang of each other. Okay. All right. Here's my requirements for entry. So that was part of my strategy and my criteria. Okay. Now here's my requirements for entry. I need the no demand bar to pass. Next bar closes down. It has to have broken the climactic action close. Does everyone know what I mean by that? This is how I increased my probability and lowered my risk. This is how I timed my entry. Because the market's volatile. I draw a horizontal line against the climactic close. Once I've identified the climactic action area, and in this case when distribution started, I mark the close. The market starts to rise, the volume starts to go away, the market starts to roll over, and it starts to come down. So remember, my criteria for this short position is that the market's already falling and I get a no demand to pass. But I want the no demand to be at or below the climactic action area. Yeah, Ed says, I use the close of the bar and Gavin uses the climactic low. You can use both. Here's the thing about climactic action on the distribution side. It usually closes to the high. Supply coming in is usually closing up near the high. It could close in the middle, but oftentimes it closes up near the high. A couple of the other signals will close in the middle. So draw a line against the close because volume spread analysis is always concerned with the close. You can also mark the low, and you've established yourself a little bit of a criteria for the range. So if you get a no demand and it breaks through that area and pushes up, and then the next bar closes down and it should close well below that climactic close, you're in good shape. If it closes even below the climactic low, then you lower your risk a little bit more. So my entry is 2 ticks below the no demand bar. I let the market come down to me. Okay, so in other words, the no demand is an up bar, and then the next bar closes down. I make sure that I put my entry in 2 ticks below the no demand, because sometimes the very next bar after that might push up a little bit, and I want to catch it on its way down. And I don't put the stop in, obviously, until I'm in the trade. I trail my stop down using 8 stops once I've entered the trade. So all of this goes in my trading plan. And then I monitor it, and if I did something different and I take a snapshot of the trade, I answer the question, why did I do it differently, and what happened? All right, exit strategy before I enter. I will exit if I'm stopped out. I will not allow the trade to lose more than X amount of money. Okay. I will run the short down until I see a bottom reversal, which is what I was telling you guys, shakeout, bottom reversal, or 2-bar reversal, and the next bar closes up. So what I mean is really this is 3 bars. So first I see, a big widespread bar coming down like a shakeout, and then the very next bar reverses. If the bar right after that closes up, I exit my trade. I use the FAR H. So it's based on 2, 1.5 and 2. And then I reserve the right to eyeball it and go a little bit wider if I need to, 2.5. But for the most part, 99% of the time, I just use the trailing stop at 2. So if I get stopped out on my own, I get stopped out. But let's say the market isn't quite ready yet to fall, even though I've read all the signs right. I will not allow me to lose more than, it depends on how much I'm trading. I will run the short down until I see a bottom reversal and the next bar closes up. All right. Unfortunately, guys, I'm sorry that Earl wasn't able to be with us at the moment, but his slides are in this PowerPoint, so you guys can look over his slides on your own time. I don't think it's fair for me to present his strategy because you guys, deserve to ask him the questions so he can answer them. I'm sure something happened, otherwise he wouldn't have intended to miss this. I talked to him a couple minutes before we started, and I think he might have just run into some issues. So, but his slides are in here, and what I'll have him do is present at least for a few minutes next Saturday and talk about them. Okay? So I will say, have an overall plan, have a specific strategy. Test your strategy before trading real money. Steve Phillips obviously forward tested 20 times. Assess your strategy in many time frames. When does it work the best? When does it not work? And that's okay too. If you know that this strategy only works in the 4-hour time frame, then that's when you use it. That's totally okay. Look for confirmation in multiple time frames, whichever time frames you prefer to use. The more specific the strategy, the lower the risk. The more specific your entry criteria. Think about all the weaknesses and obstacles we did today and how we could overcome them. Has to do with being really specific with yourself. Less is more. Definitely, less is more. If you trade less, but you're really specific and good at what you're trading, you'll increase your percentage, your winnings. Don't put all your eggs in one basket, right? Don't put all your risk management in one trade. Less is more. And it's okay to do one contract and a small, tight stop. And it's okay to test and retest things until you're absolutely sure. It really depends on your risk tolerance and how confident you are in a strategy. If you have one strategy that you've been doing for a while, great, and then you want to add another strategy, then you're going to be a lot more conservative with that strategy than you would be with the other one. You haven't quite used it yet. So does anyone have any final questions before I leave you on this wonderful Saturday afternoon? I will tell you these will be uploaded tomorrow, and then by Monday you'll have the trading plan template. Next week we're going to talk about the psychology of trading, mindset, obstacles, and Tom Williams is going to share with us his trading plan. I'm going to send you a link this week to the Law of Attraction webinar that Gavin did in September. He did one recently, but the one in September with Paul Avens was really good, and I'm going to send it to you. And the one thing I ask, I'll send it to you by Tuesday. That's my promise to you. If you could please just watch at least the first hour. It goes a little long. But if you could please watch at least the first hour before Saturday, it'll help you start to think of your own mental roadblocks and things that work against you, like you, and it'll prepare you a little bit better for Saturday. If you also happen to own the software or the plugin, within the VSA trading course is the Psychology of Trading presented by Dr. Gary Dayton, who many of you may know is a psychologist in the trading world. He actually did a public webinar that is on YouTube, on our YouTube channel. They did it this week, him and Gavin. That would be a good one to watch as well. Start to get your head wrapped around that, because that's going to be your biggest obstacle when you're sitting by yourself and you don't have me or Gavin or anybody else over your shoulder, and you're about to take a trade. These are the things that you want to think of. So if you could just please watch at least the Law of Attraction webinar from Saturday. I'll send you the link from before Saturday, and possibly consider watching the module on the VSA trading course or the public webinar that they did this week. It'll be good preparation for Saturday, okay? And Jennifer, when I leave now, I will send you an email with the Forex stuff that I promised you, okay? So all of you have a wonderful, terrific day, and thank you so much for your feedback and your time today. I really, really enjoyed it.